morning. It's me, Kenny Polcari, your host of the party, morning market commentary, everything you need to know to get your day started. As you can see, I'm here back on the beach in Palm Beach. The sun is just about rising. It's early. It's just after 7 o'clock. You can see the beautiful ocean behind me, a little bit of clouds in the sky, but it is sure to be another beautiful day here in South Florida. So what do we have to talk about? What are the things you need to know? Well, 87% of the companies that reported yesterday beat on both the top and bottom lines, right? Out of 30 companies, 4 missed and 26 beat. Is the economic data really weaker? Look for the PMIs today. We'll talk about that in a minute. And what is the Fed going to do next week? And what about the debt ceiling that no one's talking about? Oil's holding steady at $72 a barrel. The 10-year's at 1.29%, and stocks are up again today. And what are we having for dinner? We're going to have the Pasta Michelangelo. So listen, stocks churned for most of the day yesterday and ended mixed, right? The Dow was up 25 points, the S&P up 9, the Nasdaq was up 53, while the Russell and the transports each gave back 35 points, right? Exactly. Earnings did almost just as I discussed. 30 reports, 4 misses. That's 87% of the companies reporting continue to beat on the top and bottom lines. And the ones that miss are only missing by pennies, while the ones that beat are beating by dimes and quarters. Healthcare was the best performer yesterday, rising 0.7%, followed by tech and consumer discretionary. Energy, financials, real estate, and basic materials all moved a little bit lower. And so far, year to date, energy, though, is in the lead, followed by real estate, financials, and then communications. Tech is in 5th place, while the weakest sector is utilities. And that does make some sense, right? Because the market is all about growth. The market's all about excitement. Utilities is a defensive play. But if the tone should change and the broader market comes under some pressure, then you should watch for Utes to catch up. The growth trade is now up 18% year to date, while the value trade is up 14.5%. A decent performance as the fight rages on between growth and value. So how will the year end? We'll see. Economic data yesterday, while strong, was defined as weaker than expected. Leading economic indexes came in at up 0.7% versus the expected 0.8%. Existing home sales at 1.4% versus the expected 1.7%. Initial jobless claims went up to 420,000 versus the expected 350. And remember, an increase in claims is negative. The Chicago survey came in at very small versus very small, and the Kansas City Fed survey came in at 30 versus the expectation of 25, so that was actually better than expected. And many are now using the broader, weaker data along with the renewed spread of various COVID variants to get the Fed to slow down and not be so quick to change the course of monetary history. You see, many are hoping to get the Fed to reconsider the conversation that they're about to have next week at their next meeting. The Wall Street Journal lays it out very clearly that the Fed ramps up debate over taper timing and pace. Officials are set to consider a tactical planning at next week's meeting over how to reduce asset purchases. It's very interesting because we've been talking about that. The story goes on to say that they are set to accelerate deliberations over how to scale back on the easy policies considering the strength of the economic recovery, right? And no one's going to argue that we are in a robust economic recovery. Here is, though, you have to recall, this is where you kind of get back into Monday's swift sell-off. And while the media blamed it on the Delta variant, I pointed out so many other reasons for that move that made so much more sense. And the next Fed move makes much more sense. Because if the move was caused by the Delta hysteria on Monday, that would have continued to slam the markets on Tuesday and Wednesday. Because the Delta variant and now the Lambda variant continue to spread across the globe, as well as here in the United States. But as you know, that didn't happen. And the conversation on Tuesday and Wednesday completely ignored the variant and anything around it, and started to focus on more of what the Fed is going to do and what the blowout earnings are going to be and what they've been and what we're going to look for. And many are now hoping that the temper tantrum seen on Monday may force the Fed to just consider with greater detail their next move, right? Because Monday might have been kind of a precursor of what could happen if everybody gets all the hair in the back of their neck stands up. Now, just to be clear, this is a closed meeting. It's not going to be one of those usual ones that ends up with the drama of a press conference that reveals the thinking behind the Iron Curtain. That happens in August at the Jackson Hole Boondoggle, something that we're going to be discussing next month, because so much is expected to happen. But that's for another day, so let's worry about that next week. right? We should, though, expect to hear something through the grapevine, as Jay Powell has made it clear that the meeting is going to focus on these two items. When they're going to start paring back on the $120 billion of monthly purchases, $80 billion of which is treasuries and $40 billion of which is in mortgages. Why we're still supporting the housing market is beyond me. And two, how quickly that's going to happen. The answer to both of these questions, though, is going to drive the action in the weeks and the months ahead. If it's too fast, then you expect yields to spike and stocks are going to fall swiftly. Think Monday times 5. If it's too slow, then yields are going to churn higher and stocks are going to attempt to move higher, but will end up churning lower. Look, current valuations reflect current policy. So new policy is going to demand new valuations. And as the stimulus is withdrawn and interest rates begin to move up, valuations must move down. It's a simple math equation. Right? Because markets are going to have to reprice based on new valuations and based on what the plan will be. And remember, it's fluid. We're in a place that we've never been, so there's no historical perspective to guide the next move. So we're really flying by the seat of our pants. So you got to hold on and strap in. In the end, I'm not saying at all that you should be prepared for a crash. Not at all. I'm just saying that as policy changes, valuations are also going to change. And that just means that investors are now going to have to reconsider what they're willing to pay for stocks going forward, right? Currently, we're trading at 30 times the S&P earnings, a multiple that is well above the long-term average. But it's also a multiple that may make some sense in the current monetary policy. So when the monetary policy changes, then the multiple has to change. It's logic, right? And in this case, the multiple is expected to go down and not up. And all that means is that stocks will have to move lower to reflect that change. Because like the market, stocks also trade at their own multiples based on the broader policy. And at zero rates, multiples go up, as we've seen. But as rates go up, multiples have to come down. It's not that difficult. It's not, defining a disaster. It is what it is. Now, in D.C., there's more drama over the infrastructure bill that failed in the Senate yesterday. All that means is that they have to go back to the drawing board. And this morning, we're told and we're hearing through the grapevine that a new deal could happen as soon as Monday. And something else that no one's really acknowledging yet, I'm not really sure why, is the coming debt ceiling deadline, which is happening next week, right? July 30th. Republicans have already said no to increasing the debt ceiling, but we know that's just positioning themselves for the coming drama. But the conversation has to happen, and that may provide some fuel for the fire next week. Look, Congress goes on a month-long vacation beginning August 6th, so the pressure is on to get a lot of this stuff done, and they've certainly got to deal with the debt ceiling, and they've got to try to get this infrastructure deal passed. Remember, market breadth was poor coming into this latest surge higher. We spoke about that a couple of weeks ago, and that speaks volumes about the health of the market. And while we've had some rolling corrections right along the way, like the transports have been the recent sector to have undergone a correction. They were down 12%, like I said, going into Tuesday morning. The broader market has to correct a bit as well, and I think that's coming. Remember, the August through October period is a seasonally weak time for the market, and a change in monetary policy is sure to only exacerbate that mood, which is why I say be patient. You're not missing out. If you're invested, then you're participating. And if you're not invested, I'd say, what the hell are you waiting for? You got to jump in at some point. Just don't spend it all on day one, right? Give yourself an opportunity to feel how the market, trades. Listen, give me a buzz. I'm happy to assist you in getting started because everyone's got to start somewhere. This morning, we're getting ready for another dozen or so earnings that are about to hit the tape and expect them also to beat the number on both the top and bottom line. The economic data is all about the latest purchasing managers' indexes. At 9:45, you're going to get market U.S. manufacturing PMI expectations of 62. That's very bullish. Market services PMI, even better at 64.5. That's even more bullish. And remember, I've said this, the U.S. economy is a 75% services economy. So the services PMI is one that you really must keep your eye on. Also, 50 is the dividing line. Remember that. Anything north of 50 is expansionary. Anything south of 50 is contractionary. Don't worry about contractionary. We're nowhere near 50. U.S. futures this morning are higher again, right? So much for the hysteria caused by the Delta variant, right? And if you come to Florida, it is business as usual down here. You don't even know there's a variant out there. Dow futures are up 135 points. S&Ps are up 20. Nasdaq's up 80. And the Russell's up 16. Tech earnings post the close are being cited as the reason for this morning's strength. Twitter and Snap both killed it. And they're trading up by 5% and 16% respectively. Intel, which beat but that's trading flat as there was some concern going forward about supply chain issues and the semiconductors, blah, blah, blah. Oil's trading at $72 a barrel. The 10-year Treasury is holding steady at 1.29% and looks like it's probably got no reason to move up or down significantly, so I expect it kind of to end there. Bitcoin is holding steady at 32,000. Ethereum is holding steady at 2,050, and Dogecoin's trading at 16 cents. The S&P closed last night at 43.67 and looks like it's going to test its most recent high from last week, which is close to 4,400. As if Monday never happened, right? Remember, a faster than expected tapering and another spike in the variants of the virus remain risk factors for the markets, especially as we come into the fall. Some analysts are expecting as much as a 15% correction in the broader market. While I would love to see that, I'm not in that camp. I'm thinking at best maybe we get a 7 at 10% correction at best. But so much is going to depend upon what Jay Powell says. So stick to the plan. Remember, investing is dynamic. Keep some cash ready to deploy, but don't be so quick on the trigger just yet. You're going to get your opportunity. Now, you know what you can always do? I keep telling you this. You can text the word invest to 21,000 on your phone. You'll get my digital business card downloaded straight to your phone. Feel free to give me a call, send me a text, send me an email. I'm happy to talk to you about a plan. I'm happy to talk to you about the markets. I'm happy to talk to you about any concerns. And I'm happy to talk to you about life in Florida on the beach. You know, you can always also find me on Twitter. My Twitter handle is just my name, at Kenny Polcari. And you'll see me. And this morning, you'll catch me at 9 o'clock on Stuart Varney on Fox Business with Stuart Varney. Okay, so what are we having for dinner tonight? This is another one of those classic dishes, right? This is called the Pasta Michelangelo. Today, I'm serving it with gemelli. Gemelli is a type of pasta. Gemelli is twin in Italian, but it's a type of pasta. It's a simple dish to make. It was a favorite, apparently, of Italian sculptor, painter, architect, and poet of the High Renaissance, right? A man of unparalleled influence over the world. Michelangelo has been long considered one of the greatest living artists in the world. He was also known to be a simple man enjoying simple dishes, and that's exactly what this one is. So give it a try because it's easy to make. Now for this, you're going to need a pasta. Today I'm serving it with gemelli, but you should use a short pasta for this. You need fresh spinach, yellow raisins, pinoli nuts, fresh ricotta, olive oil, butter, and some fresh grated Parmigiana cheese. Start by bringing a pot of water, salted water to a rolling boil. You know that. Put the top on it. Leave it ready. In a bowl of hot water, take your raisins, your yellow raisins, and soak them so that they plump up again. Let them soak for 10 or 15 minutes. Now, in a deep frying pan, you're going to add a bit of olive oil and a dollop of butter, a bit of olive oil first, and you're going to toast the nuts, right? You want to toast your nuts. Toast the nuts, stirring them not to burn, right? Then take them out and set them aside. In the same pan now, add a little bit more olive oil and a dollop of butter, and then add the spinach. Season it very lightly with salt and pepper and then saute it. You know, it wilts right down, right? So you can add a lot of spinach because it wilts right down. Now you're going to add the pasta to the pot. That's going to cook for 8 to 10 minutes. After about 3 minutes that you've been sauteing the spinach, now you're going to add a small container of fresh ricotta cheese. You want to stir it in. You want to let it melt and blend with the spinach. Now you're going to add the raisins without the water. When the pasta is done, remove it directly from the pan and put it right in the frying pan with the spinach and ricotta mix. Now you're going to add a ladle of the pasta water to this mix, right? You want it to be moist. You don't want it to be wet. You just want it to be moist. You're going to toss it to mix it. You're going to add the pinoli nuts, toss it again, add a handful or two of fresh grated Parmigiana cheese, toss it and serve. And again, if it feels like it's drying out, you can always add just a little bit more of the pasta water. But again, keep it moist and not wet, right? One way or the other, it's a simple dish to make. The whole thing probably takes you 30 minutes max, start to finish, by the time you get all your stuff together and you put the pots on the stove and you cook it and you do all that. But it's a great dish. It's easy to make. It's filling. Your family's sure to like it. There's nothing bad in it. I mean, there's spinach, there's pasta, there's pinoli nuts, there's olive oil, there's Parmigiana cheese, there's ricotta cheese. I mean, how could any of that be bad for you, right? One way or the other, it is early Friday morning. The sun is just about to come up. Have a great day. I'll have a great weekend. Take good care, and I'll see you on Monday.